While many people are panicking about rising interest rates, some investors are taking advantage of this to make more money. And today I'm going to show you how rising interest rates can become an opportunity for you. Hi everyone, I'm Sophia Carter. Before we begin, comment below. Do you prefer investing in fixed income or stocks? Be sure to follow the channel, because here I share content about investments, artificial intelligence, and financial opportunities that can completely change the way you see money. When interest rates rise, credit becomes more expensive, consumption slows down, and the entire market feels the impact. But there's a detail that many people ignore. How Treasury Select, CDBs, LCIs, and other fixed income assets. In other words, money that's not being used starts to earn more. First, let's understand the basics. When the central bank raises interest rates, the goal is usually to control inflation. In other words, to try to slow down consumption and balance the economy. But what does this change in practice? Financing becomes more expensive. Loans increase. Credit card fees go up, and companies also start paying more to borrow money. And that's exactly why many investors get scared. Because stocks can fall, companies can slow down, and the market becomes more volatile. But here's the detail that many people don't realize. High interest rates also create huge opportunities. Because when rates rise, some investments start paying much more. And that's when fixed income starts to attract attention. Treasury Select, CDBs, LCIs, LCIs, fixed income funds. All these assets can start to offer much more attractive returns. And do you know what that means? That even more conservative investors can make their money grow better, with less risk. Now think about it. If an investment used to pay little, and now it starts delivering higher returns, many people start migrating money to fixed income. And that completely changes the behavior of the market. But hold on, this does not mean that stocks cease to be worthwhile. In fact, many smart investors take advantage of these downturns to buy good assets at lower prices. Because while most sell out of fear, experienced investors analyze the long term. And here's something very important. Investing is not about emotion. It's about strategy. Many people lose money because they make impulsive decisions. They buy when prices are going up and sell when they're going down. And that's exactly where artificial intelligence starts to make a difference. Today, there are AI tools capable of analyzing thousands of data points in seconds. They can identify patterns, compare economic scenarios, assess risks, and even suggest strategies based on your profile. Something that only large investors could do before is now available to ordinary people. And this is completely changing the game. Imagine being able to ask AI, which investments tend to perform best in high interest rate scenarios? And receive a complete analysis in seconds. Or, how can I diversify my portfolio to reduce risk? This saves time, improves decisions, and helps beginner investors better understand the market. But here's a very important warning. AI does not replace knowledge. It helps, accelerates, organizes, but you still need to understand the basics. Because no investment guarantees profit. And one of the biggest mistakes beginners make is investing without understanding where they are putting their money. Therefore, before investing, you need to understand 3 things: your goal, your time frame, and your risk level. Do you want monthly income? Do you want long-term growth? Do you want to protect your assets? Because each strategy works best for a different profile. And do you know what yours is? Comment here for me. And that's exactly why copying other people's investments can be dangerous. What works for one investor may not work for you. Now, if you're starting out, maybe the best strategy is simplicity. A balanced portfolio with fixed income, some real estate funds, and a portion in stocks can already be a great start. And do you know what the secret is? Consistency. It's not about investing a lot once. It's about investing consistently. Even small amounts, when invested frequently, can grow a lot over time. And most people only realize this too late. Because unfortunately, nobody learns financial literacy in school. But today, with the internet, content, and artificial intelligence, you can learn much faster. And those who start now can be years ahead in the future, because idle money loses value. But invested money works for you. So pay attention to this. The next few years could create enormous opportunities, especially for those who understand technology, artificial intelligence, and investments. And those who ignore this may end up falling behind. Now, I want to know from you. Do you prefer fixed income, stocks, or are you still learning about investing? Comment below, because I read the comments and I can bring you videos exactly about what you want to learn. And if this video helped you, leave a like, follow the channel, and share it with someone who needs to understand more about money and investments. Thank you for watching until the end. And in the next videos, I'll show you how to build a smart portfolio using AI, even starting with little money. So subscribe to the channel. Comment, invest below. See you in the next video.